silver did not simply roll into 2026. It arrived under tension. As of January 2nd, silver is trading around $74 to $74.50 per ounce, stabilizing after one of the most extreme years in its history. In 2025 alone, silver surged more than 150%, outperforming gold and nearly every major asset class. That kind of move usually ends in exhaustion. Instead, silver is holding. The final weeks of December were volatile. Prices briefly spiked near $84 per ounce before a sharp, fast pullback dragged silver below 73. That move looked dramatic on charts, but the cause was mechanical, not fundamental. CME margin hikes and year-end profit-taking forced leveraged positions to unwind. Once that pressure cleared, silver stabilized almost immediately. What matters is what changed at the start of the year. On January 1st, China implemented a new export licensing system for refined silver, replacing its previous quota framework. This is not a symbolic change. It introduces friction into global supply chains at a moment when silver availability is already tight. 2026 now marks the fifth consecutive year of a global silver supply deficit. Industrial demand has not slowed, it has accelerated. Artificial intelligence data centers, solar panel manufacturing, power electronics, and electrification infrastructure are consuming increasing quantities of physical silver. Unlike financial demand, this metal is not coming back to the market. It is being locked into systems. At the same time, monetary conditions remain supportive. Markets expect further Federal Reserve rate cuts in 2026. Lower real yields reduce the opportunity cost of holding non-yielding assets, and silver benefits directly from that shift, both as a monetary metal and an industrial input. This cycle is fundamentally different from past silver rallies. COMEX registered inventories are sitting near decade lows. London Vault holdings have fallen by roughly 1/3 since 2022. Physical availability is tightening quietly, without panic, which is often when the largest moves form. This is not a retail-led squeeze, it is institutional. Large buyers are competing for physical silver required for energy systems, data infrastructure, and strategic manufacturing. That demand is not sensitive to short-term price swings. Institutional forecasts for 2026 reflect this tension, even though they differ on how far prices can go. UBS expects silver to peak between $57 and $65, assuming a gold-to-silver ratio near 75:1. Bank of America sees prices closer to $65, driven by persistent industrial deficits. Other institutions see a much higher ceiling. Goldman Sachs views silver as a supercycle beneficiary, outlining scenarios where prices test $75 to $100 if supply tightness accelerates. JPMorgan frames silver as part of the debasement trade, with upside above $80 as investors hedge fiscal deficits and a weaker dollar. There are dissenting views. Citigroup remains cautious, warning of a potential correction if speculative momentum fades, but even that outlook does not dispute the long-term structural deficit. Some market participants see upside arriving sooner rather than later. Wanda projects silver near $90 in the first half of 2026, driven by geopolitical risk and safe haven demand. Technically, the framework is clear. Silver must hold $70 to preserve its upward structure. Resistance sits near 78 and 85. A sustained break above those levels would put new highs firmly back on the table. What makes this moment different is not excitement, it is necessity. Gold is held for protection, silver is consumed for function. When a metal is both a monetary hedge and a critical industrial input, price is no longer just about sentiment. It becomes about availability.